So the fair value option. You need to know what the fair value option is and have a general understanding of it, but I probably won't, the most of them might be is a multiple choice question on this. I'm not going to have you doing the journal entries. However, it's good to understand. And now I have to start, now we're talking about the fair value option as relates to liabilities. Bonds payable, notes payable reported at their fair value on the balance sheet rather than at the way they're usually reported. But before we get to the liability section, I think it's helpful to start with what we already have known from the assets section and fair value reporting. So just to review that quickly. If you have debt investments trading, say they're on the books for $100,000 and their fair value has dropped to $90,000, you would make the following journal entry. You would record an unrealized loss income, which gets reported on the income statement, and then you do market adjustment trading. And that would, you'd have debt investments, net of the market adjustment, and the asset debt investments would be reported on the books at its fair value of 90 rather than the book value, previous book value of 100. Okay, with available for sale debt investments, you'd have you had the same situation here where the book value was 100 and the market value had dropped to 90, you'd recognize an unrealized loss equity and you'd make your market adjustment and they would be reported on the balance sheet as investments of 90,000. So that's your reporting at fair value for assets. That makes sense, right? Then we come over to reporting liabilities at fair value. Okay, let's take a look at bonds payable. First of all, bonds payable are usually reported at what they call their amortized cost, okay? So you have bonds payable, less discount on bonds payable, and that's your carrying value on your balance sheet. Or bonds payable plus premium, and that's your carrying value. As an alternative, companies can elect to report their liabilities, their bonds payable, I'll just keep it simple at that, at fair value. But look what happens. When you're reducing the value of your investments, you're recognizing an unrealized loss income, and here's your market adjustment trading, which reduces the value of your investments. Look what happens when we make the same change to our bonds payable. We have a decrease in the value of the bonds payable, so we're debiting our bonds payable to get it from, we had bonds payable of 100,000 and now they're only 90,000. So since it's a credit balance account, to get it to 90, we're going to be debiting our bonds payable that 10,000, right? And look at this. We've got a decrease in the value of the bonds payable and we're recognizing a gain, an unrealized holding gain, income. Now, that is in the situation where the change in the fair value is due to the change in the market interest rates. So there's a couple of different things that can happen. It can be because of a change in the interest rates. That's sort of something the company cannot control. And so in that case, they're going to be reducing the value of the bonds. Maybe our bonds are paying 6% and the market rates just went up to 8%, so our bonds have declined in value. Okay. Then you have to think about another thing that could have happened to reduce the value of our bonds, and that could be that we've had a decrease in the value of our bonds because our company is in trouble. We've got a decrease in the creditworthiness of our company. And so now you're going to be debiting the bonds payable to reduce it, okay? And just going to be recognizing an unrealized holding gain, which is going to increase, gain as the company's going under. Now this used to be reported on the income statement, and FASB, for obvious reasons, decided to put, when it is this situation, we're going to treat it as equity. It will bypass the income statement and get reported in the stockholders' equity section. Because otherwise the company could be going down the tubes and we are reporting unrealized gains. That wouldn't make any sense. Okay, so fair value, you just need to be aware that the liabilities can be reported at fair value. Logically, it does seem a little weird because as you're reducing the value, you're recognizing unrealized holding gains. So that's, yeah, and I'm not gonna be asking you to do any journal entries on this. So that's your fair value option for liabilities.